Welcome everybody to the Texas REIAs, the largest network of real estate investor associations and real estate investors in the great state of Texas, with over 100,000 members, participants, and attendees going all the way back to 2003. They say if you have the even slightest interest in real estate, the very first thing to do is to go join your local real estate investor association, because real estate investor associations provide resources to people interested in real estate. What kind of resources? Well, power teams. You know, you just saw some power team resources. Maybe you need tools. Maybe you need training. Maybe you need money. Maybe you want investment opportunities. Maybe you're looking for a network of people to invest with. Maybe you're looking to raise money. Regardless of what you're looking for, you can find it at your local real estate investor association. My job is to make you all into educating, contributing members of this community. So the first thing we're going to do today is we're going to do a market update. We provide all kinds of resources to real estate investors. We're going to talk about what's going on in the marketplace. I've got a whole bunch of data to share with you, and we're going to kind of go through the data right now and talk about what's going on. So first things first, what's probably the biggest story about real estate over the last couple of years? What's changed over the last couple of years? A little audience participation. What's changed? What is it? Interest rates. Interest rates changed. That's true. Okay, interest rates changed. So what happened to interest rates? They went up or down? They went up. They went up. Okay, interest rates went up. Got it. Now, so they're different than they were before. So let's do a little poll of the audience. Let's make this interactive. I'm going to give you two choices. There's no right or wrong, so I'd like you all to vote for one or two. And it's just opinion, because you can't have a bad or wrong opinion. Do you think interest rates are high? Do you think interest rates are low? Okay, so let's see what the audience thinks. Who thinks that interest rates are high? Raise your hand if you think interest rates are high. Okay, you guys over here, who thinks interest rates are high? Who thinks interest rates are low? Who thinks interest rates are low? Okay, we're not getting this side of the room. It's a really easy question. Let's try this again. Who thinks interest rates are high? No right or wrong. Okay, who thinks interest rates are low? Who thinks interest rates are low? Okay, we got a lot of highs and a couple lows, and some people are still not answering the question. Okay, so it's an opinion. Your opinion can't be wrong. Your opinion can't be wrong. So I have been investing in real estate for 20 years, since 2003. I own about $30 million worth of houses here in Texas, and most of them have a mortgage with an interest rate between 6.5% and 7.5%, because that's normal. And my opinion is that interest rates are normal. It's just an opinion, okay? By all historic standards, 6.5% to 7.5% is normal. Now, a few years ago, interest rates got all the way down to like 3%. Now, when interest rates were 3%, prior to a few years ago, before that, when did that happen before that? When has that happened in the past? Anybody know? That would be never. Never. It's never happened before in your lifetime, in your parents' lifetime, in your grandparents' lifetime, in your great-great-great-grandparents' lifetime. Never in the history of the universe has that happened before. So when is it going to happen again? I have no idea. We can't tell the future. My guess, never. Like never in your kid's lifetime, your great-grandkid's lifetime. I don't know. Nobody really knows. But I think the world that would have to happen to make interest rates go to 3%, you know, you're going to be more concerned with getting ammunition for your AK-47 to, you know, fight off the zombies in the zombie apocalypse than you're going to be worried about interest rates. But by my opinion, it's just opinion, interest rates are normal. And personally, I like normal. I like normal a lot. I don't like abnormal, okay? I invest in residential and I invest in commercial. We're going to talk about both. We do both. We love them all. We love all the assets, all the strategies. We're not here to try to convince you that one way versus another is better than the other. They're all great. They just have different benefits, right, when you compare them to each other. But when it comes to commercial real estate, here's how commercial works. You buy a property, and typically a commercial flip or syndication is a 5-year deal. Everything's like set up for 5 years. Right? Residential loans are 30-year loans. Commercial loans are not 30-year loans. Commercial loans are 5-year loans. Because people don't want to invest in things for 30 years with their money. They want to invest in things for like 5 years and double their money and get it back so they can do something else. So in general, commercial deals are all set up to sell, buy, sell, buy, sell, buy, like every 5 years. So like 5 years ago, people were buying these commercial properties. We do all kinds of commercial, including like multifamily apartment buildings. So people were buying apartment buildings, and it was very competitive, very competitive. And because it was very competitive, people were paying top dollar, okay? And they made the deals work. And the reason the way they made the deals work is they got them financed with 3% mortgages. So if you pay top dollar, but then you can get a 3% mortgage, you can collect enough rent to pay the mortgage at 3%. But now interest rates are no longer abnormal. Now they're normal. Now they're 7%. And if you buy the apartment building today, if the guy tries to sell the apartment building you bought 5 years ago today, the new buyer, even if they pay the same amount, the numbers don't work with a 7% mortgage. So they're kind of in trouble. You know, Wayne Gretzky's famous quote, "I don't skate to where the puck is, I skate to where the puck is going." So if you're doing commercial real estate, you kind of have to ask yourself the question, okay, I'm gonna sell this property in 5 years. What's the world likely to look like? We don't know. We never know for sure. But I would say if you're in a world that has never happened before in the history of the universe, that's not a reasonable thing to expect to continue. If you're in a world that by all historical measures is normal, that is a reasonable thing to expect to continue. So 5 years ago, I hated commercial, and today I love commercial, okay? Just because the market is normal, and I like normal. You know, and speaking of like commercial and residential, we do both, residential and commercial. You know, a few years ago, the market was red hot. It's still actually pretty good. But, you know, sometimes it's easy to buy and hard to sell. Sometimes it's easy to sell and hard to buy. It's never easy to buy and easy to sell, okay? Pick which one you want. You know, you can't have both. Right now, it's kind of in the middle, right? A few years ago, it was impossible to buy. It was hard to buy because it was so hot and everybody was just going crazy and the prices were going crazy. And people were overbuying and over-improving and making all the typical rookie mistakes. Now, things are normal, right? And so I would argue, you know, you can always invest in real estate. I would say this is the best time in several years to get involved, to get started, to start investing in real estate. Now, you can always jump in, but I'm going to argue for those of you that are just getting started, good timing, guys, nice timing. But going back to interest rates and the market update, show you some interesting data. Okay, this is a chart going all the way back to 1970. From 1970 to 1981, interest rates on mortgages got all the way up to 18%. 18%. Holy cow. So for any of you that are like thinking like 7% is high, how about 18%? Now, let's do another poll of the audience. Another poll of the audience. When interest rates go up, what happens to home prices? No right or wrong answer. We're going to do a poll of the audience. You got a choice, up or down. What do you think? Who thinks when interest rates go up, home prices go up? Okay. Who thinks when interest rates go up, home prices go down? Okay, we got a lot of downs and a couple of ups. Okay, I would argue it does both. You see, here's the thing you got to learn about real estate. Real estate doesn't actually care about interest rates. Real estate doesn't really care about the economy. Real estate cares about two things, supply and demand. Supply and demand. It's purest market there is, supply and demand. So only in as much as interest rates or the economy or whatever affects supply and demand does it affect real estate. Okay, now, when interest rates go up, okay, for sure, houses are less affordable. You can afford to buy less, so fewer people can afford them, and that means the demand goes down. And when the demand goes down, that pushes prices down. That pushes prices down. But there are some offsetting things happening as well. What is offsetting? Let's talk about some of the offsetting things. Number one, in 2002, 3, 4, 5, 6, 7, we had something called subprime lending. The banks gave anybody that could fog a mirror held under their nose a loan. That was the loan application process. And from 2002, 3, 4, 5, 6, 7, Money was just free and easy. Everybody could get a loan. And builders were building houses out over the horizon in every direction as far as the eye could see. And then what did they do with all those houses? They gave everybody a loan. Anybody, if you could walk into a bank and say, I want a loan, they'd hold a mirror under your nose. If they saw fog, you got a loan. And then in 2008, all of the banks went bankrupt. How about that? Yeah, turns out that was a really stupid way to give out loans, okay? But they were too big to fail, so we bailed them out. And eventually the banks got back into the lending business. But when the banks went bankrupt in 2008, lending just came to a stop. It didn't slow down. It was like a train that hit a wall. It just stopped. Okay, so you had all this supply and no more money, i.e. no more demand, and the market crashed. Okay? Now, eventually banks got back into the lending business, but now all these years later, what do you have to do today to get a loan? Turn over your firstborn, fill out a 1,900-page application, submit some blood samples. You have to do a lot. Money got cheap, but it never got easy. And because it never got easy, we've never caught up. In fact, you may or may not know this, but how many of you know that we are actually right now in the middle of a housing shortage? Who's heard of this? Some of you have heard of this, yeah. We have 6 million fewer houses than we need for all the people that need a place to live. In other words, we don't have enough supply. And when you constrict the supply, what does that do to home prices? Pushes them up. What else is pushing things up? Well, we raised interest rates. Why did we raise interest rates? To battle what? Inflation. Inflation. Now, when people talk about inflation, I have to tell you, every time I hear about inflation, they always talk about like it's this bad thing. We have to beat inflation and whip inflation and stop inflation. I disagree. Personally, I love inflation. I just have another name for it. You know what I call it? I call it appreciation. Yeah, because when all of your wealth is in real estate, you go to bed hoping for more appreciation. Because when the money becomes worth less, where do you want your wealth? In stuff, right? When the money becomes worth less, it's because everything else is becoming worth more, right? So where do you want your money? You don't want it in money. You want it in real estate. You want it in gold. You want it in physical things, right? Because those things go up. So the reason we have, higher interest rates is because prices are going up, i.e. real estate is going up. So there's another thing pushing up, okay? And then there's another thing pushing up, right? Typically, historically, 2/3 of the houses that are sold are resale houses and 1/3 are new construction. At the moment, it's inverted. At the moment, it's 2/3 new construction, only 1/3 resale. People are not selling their houses. They should be. Right now, the economy is not bad. At this point, during a normal economy, people would say, honey, let's go buy a nicer house. But they're not doing it. They're not selling their house. How come nobody wants to sell their house? Because they got one of those 3% mortgages and they don't want to give it up and get a new house with a 7% mortgage, right? So all that inventory that should be offered for sale is being held on the sidelines. So yes, interest rates, right, are limiting demand, which is pushing prices down, but inflation, housing shortage, and the fact that nobody's reselling their house are pushing prices up. So we have things pushing down, we have things pushing up. Now, this is an interesting little line here. This red line is median home prices. And from 1970 to 1981, interest rates on mortgages got all the way up to 18%. And when interest rates went up, you know what happened to home prices? They actually went up. And when interest rates came down, you know what happened to home prices? They actually went up some more. And when interest rates went up and down, up and down, up and down, home prices still went up. Now, there's some bubbles. There's a bubble, right? That was at 2008, 9, 10. There's little bubbles and big bubbles, right? But yeah, it's not as simple as just saying, oh, interest rates go up, home prices go down, because there's different effects. So I'm going to give you a bunch of data to show you where we are. We'll give you a forecast. And I will say this. I do want to put a disclaimer here. All of this data is pulled from the Texas A&M School of Real Estate and a number of online sources. We will post this on our social media. You're welcome to download it. As a real estate investor, you should always be a student of the market, so you should be abreast of what's going on. We're going to talk about what to do in the current market, but I do want to issue also a disclaimer. We don't have an agenda here to try to convince you. We're not trying to sell you anything. We're not trying to persuade you the market's going up or down or sideways. We've been forecasting the market for 20 years. When we think it's going to go down, we give the data, we say we think it's going to go down. When we think it's going to go up, we give the data, we say we think it's going to go up. When we think it's going to go sideways, we give the data, and we say we think it's going to go sideways. So that's what we do here. There are groups out there, like the National Board of Realtors. They always think the market's going up, and they always make an argument that it is, right? Because they're always trying to say, now you should buy a house, right? Well, sometimes they're right, and sometimes they're wrong. So we got things pushing up, we got things pushing down, and if you put all that in a blender, what do you got? Prices are flat. Prices are flat. And what I'm going to do is I'm going to dive into some of the different cities, and we're going to talk about what's going on in the different cities. So starting with Texas. So this is the Texas State Roundup. The average price house in the state of Texas is $433,000. And it's actually up 1.5%. Basically, it's flat. Median price home in the state of Texas is $345,000, and it's basically flat year over year. We got things pushing up, we got things pushing down, but the market at the end of all that is just flat. Now, months of inventory. In my opinion, this is the number to watch. Months of inventory, if you really want to know where the market is, what's going on, look at inventory, 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 inventory. What is inventory? Well, the best way to explain inventory, months of inventory, would be this. If you took all the houses that are for sale, and you keep selling them, but you stopped adding any new houses for sale. You just sell what you got until the shelves are empty. You don't add any more inventory, right? Don't add any more houses for sale. The question is, how long would it last? How long would it take before you're out of houses? And the answer is 4.7 months. We have 4.7 months of inventory. Now let's put that into perspective. What does that mean? They say if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you have a neutral market. We are in a seller's market. And sometimes people are saying, well, is it a buyer's market? Is it a buyer's market? No, it's actually still a seller's market. Now, it's not as strong of a seller's market as it was a year ago, because a year ago it was a hot seller's market, and now it is a mediocre seller's market. But kid not, it is still a seller's market. The inventory, the number of listings is up. That's why there's more inventory. Closed sales is up a little bit, not much. If you take a look at the historical data, 2021 prices went up 18% in 1 year. 2022 prices went up 10.7% in another year. 2023, it flattened out. So it went up a lot, up some more, and then it just flattened out. The volume is down. What does that mean? Why are prices not down? Because the volume is down. Yes, there's fewer buyers for sure, but there's also fewer sellers for sure. And that means there's just less buyers, less sellers. Prices are flat while the volume is down. All right, let's take a look at some of the other cities. Houston, Texas, average price, $445, up a little bit, 4.7%, kind of significant. Median price, $350, up 3%. Closed sales, up a little bit. This has actually turned a little bit. Months of inventory, 4.3, pretty good market in Houston. Lease prices are up 2.6%. So a little commercial data point there. When lease prices are up, what does that tell you? Does that tell you apartments are full or apartments are empty? What does it tell you? They're full, yeah. When there's a lot of vacancy, prices go down. When there's not a lot of vacancy, prices go up. So there's still upward pricing pressure. 2021, some historical data. Prices of houses in Houston up 16% in 1 year, 2022, up another 10%, 2023, flat, flat, flat. Okay, the big D, Dallas. Dallas is the second most expensive city in Texas, and it has an average price of $525,000, up 2%, median 410, down 1%. Both, basically, these are flat. Months of inventory, 3.9 months. It's actually the strongest market, major market in Texas. Not as strong as it was a year ago, and a year ago it was on fire, 2.5 months of inventory, but it's got 3.9 months of inventory. Closed sales are actually up, so we're seeing that turn. Lease prices are flat. Now, I'll tell you something about Dallas. I have no idea why this has always been the case, but for some reason, Dallas has always been the bellwether of Texas. So if you want to get a clue about where the market's going, Dallas, for some reason, has always been the first one to move. I don't know why. There's something about the mix of the economy there or whatever. So there's certain things you look at to give you a clue where the market's going. You look at inventory. We talked about that. You look at Dallas for some reason. You also look at condominium inventory. We call condominiums the canary in the coal mine. If you can sell a condo, you can sell anything. Because when the market starts to go soft, condos are the first thing to go down. When the market comes back, condos are the last thing to come back. So that's why we call condos the canary in the coal mine. So if you look at condos, if the condo market is starting to go, houses come after that, right? For some reason, Dallas is a bellwether as well. So 2021, prices in Dallas were up 20% in 1 year. 2022, up another 15% in 1 year. 2023, flat, basically up 1%, which we would call flat. Okay, and then we have Austin. And Austin, my friends, is an outlier. It is a unique city in Texas, and I'll show you why. The average price house in Dallas, by the way, is $374,000, down 3%, 3.4%. Median's $450,000, down 2%. This is not a typo. We did a little research to try to better understand this, and it turns out the word Austin is actually Latin for San Francisco. Yeah. Elon Musk moved to Austin, yeah, and Meta and Apple and Amazon all set up offices here, and Samsung and all these engineers making six figures, and everybody's moving to Austin. You guys know that. And because of that, prices have gone crazy in Austin. Months of inventory, 4.8 months of inventory. Still a seller's market, not bad, not as strong as it was a year ago, 3.7 a year ago. Sales actually up a little bit, basically flat. But this is why Austin is an outlier. Let's talk about Austin. 2021 was the outlier. In 2021 in Austin, Texas, prices in Austin, Texas of houses went up 29% in 1 year. And I was there. Most of my houses are in Austin. In 2021 in Austin, Texas, you would put a house on the market for sale and they would get 11 offers in a weekend. 1 would win, 10 would lose. So the 10 that lost would put an offer on a second house. They got 11 offers in a weekend. 1 would win and 10 would lose. And this would happen over and over again. And the buyers got so furious with their realtors after getting outbid over and over and over again that they just started screaming at the realtors. What do you have to do to buy a house? I need a place to live. What do you have to do? And in that very never before happened market in Austin, Texas, because in Austin, Texas in 2021, there was 0.4 months of inventory, 0.4, less than 2 weeks of total inventory. Never happened before. In that very abnormal, never happened before market, it became normal in 2021 for people to buy houses 5 to 10% above appraised value. By the way, the bank will not allow you to buy a house above appraised value. Just so you know, the total down payment plus the total loan cannot exceed by $1 the appraised value. If you really want to buy a house above the appraised value, you put down your down payment, you get the loan, and then you have to come with a pile of money after that to put on top of all of that. And in 2021, it became normal for people to buy houses 5 to 10% above appraised value. In 2022, it did not get much better because prices went up another 10%, and then in 2023, it went down 8%. So in most of Texas, it went up 30% and it flattened out. In Austin, it went up 40% and came down and it flattened out. Perspective, right? If you bought a house 3 years ago in Texas, you made 30%. Congratulations. If you bought a house 1 year ago in Austin, you lost 10%. And that is just perspective, right? I've been buying houses in Austin and the rest of Texas for 20 years. So they go up, they go down, but over time, of course, they go up. Lease prices are down 2%, not really much. There's a lot of inventory that's come on board. And then finally, we have San Antonio, the most affordable major city in Texas. Average price in San Antonio, $376, down 2%, basically flat. Median price, $320, also flat. Closed sales is up a little bit. Months of inventory, 5.3 months of inventory. For some reason, it's the slowest market in Texas, major market, but still not bad. 2021 prices went up 16% in 1 year. 2022, they went up another 12%. 2023, flat, or down 2%, which we will say is flat. So that's where we are. Now the question is, where are we going? Well, kind of like I said before, there's things that are pushing up and there are things that are pushing down. So let's take a look at some of the drivers. The first one is the economy. Now, real estate doesn't care that much about the economy. During the Great Depression, real estate prices went down a whopping 6%. Not much. During the Great Pandemic, another 1 in a 100-year thing, right? Real estate prices went up 30%. So it's not the economy. Although the economy has some secondary effects on real estate. The economy is doing well, people feel a little better, and they're a little more likely to buy a house. Consumer confidence. Consumer confidence is rated on a scale of 1 to 200. I don't know why they do that, but if people score confidence over 100, they're confident, under 100, and they're scared. Right now, it's right in the middle, 102, it's just over the middle. So people are a little confident, not feeling too concerned. It means they're a little more likely to buy real estate. Unemployment rate is solid. Anything under 5% unemployment is considered pretty much full employment. In Texas, we're at 4%, so we got a great economy. Job growth, we're building jobs here in Texas, so that's a good thing. So we got good job growth. Stock market, real estate doesn't care about the stock market other than in a secondary way. If people look at their 401k and it went up, they're like, we're doing okay. Maybe we can buy a bigger and nicer house. Last year, the stock market really did well. So people looked at their 401k and they did really well. And then we have interest rates. Interest rates, of course, have reduced affordability. So that's something pushing down on the marketplace. House price trajectory flat. So it's not really pushing up or down, it's just flat. Closed sales trajectory, it's turning. Right, it's down a little bit, but in some of the markets, it's actually up a little bit. Pending sales is flat, so that's another one that's not really pushing up or down. Active listings, flat, adding at a moderate pace, just kind of keeping up with the population and the demand. Months of inventory is pretty good, right? We have less than 6 months of inventory. We're still in a seller's market, but it's a weak seller's market. But technically it's still a seller's market. Housing permits, we are adding more supply, but we're barely keeping up with demand. In fact, we have a lot of demand because of the migration issue, and let's talk about migration. In migration. Now, the truth is, I should have made this a triple size bullet. Not all of these things are really the same size. This is a big one. Migration is probably the biggest bullet on the page. What is migration? Migration is the ratio of people moving in versus moving out. And everybody is moving to Texas. Last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where do you think they went? Yeah. So, and then there's like another 15 million people we don't really know where they came from, and we don't know really where they ended up either, but a bunch of them are probably here too. So we have a lot of extra people in Texas, and everybody needs to live somewhere, in a house, in an apartment, in something. So that is a big push up, and that's a big one. Construction labor, let's talk about that a little bit. Yeah, it's getting really expensive to build a house, and it's all labor costs. Labor is crazy expensive. And the problem is that general contractors are dying. Right? The average general contractor is like 58 and a half years old, and they keep getting older. Right? And the young kids are not becoming contractors. So here's some advice. If you have a teenager, don't send them to college. Buy them a hammer. Okay, I'm dead serious. They can make crap loads more money. They're going to make 3 times as much money as the college grad. They're going to have no debt. They're going to be really happy, and they're not going to have to work for a jerk, right? So yes, you know, make them into contractors. Contractors are making a fortune. You know, I used to be able to build houses for like $100 a foot, and then it was 120, and then it was 150, and then it was like 180 a foot, and then it was 200 a foot, and 220 a foot. And now sometimes it costs like up to $300 a foot just to build a house, right? You can't even afford to build a house. I mean, the materials are high, but the labor is off the charts. And then finally, we have some wild cards. There's a little election going on. Interest rates, we don't know exactly where they're going. There's a few wars going around. There's some inflation kind of going on in the background. So we got things pushing up, we got things pushing down. I don't know, guys, let's do a little vote. I have no idea. Let's take a vote. Who thinks, based on all the data, prices are probably going forward, probably going to go up? Who thinks prices are probably going to go up? Okay, who thinks prices are probably going to go down? Okay, we got some ups and we got some downs. I'll give you our forecast. We think the market bottomed out about 6 months ago. It basically went up and up and up, it bottomed out, it's not going anywhere. Interest rates are probably going to fall as early as September. That's what all the smart money says. And if interest rates do fall, that's kind of one of the very last things that's keeping people on the sidelines. So that will probably be a modest juicing of the business. So that'll probably give the market a little bit of a jolt, but not much. Our overall forecast is we expect prices to be basically flat. Sales volume will probably increase by a couple percent by the end of the year. Prices will probably be up 2 to 3% by the end of the year. There's just nothing big happening that's likely to affect things a lot. And I will tell you, we've been doing market forecasts, and this is not my forecast, I just report the forecast, but we've been doing forecasts for 20 years. And the REIA has always been very accurate in the forecast. And I'm going to say it's not because we're smart. I'm going to say because it's easy, okay? Trying to predict the economy is very, very difficult. Very difficult, borderline impossible. Trying to predict the stock market, I will argue that is impossible. Pure speculation, you're betting against speculation. It is impossible to predict the stock market. Trying to predict real estate, not that complicated. And the reason it's not that complicated is because it's all supply and demand. And we know almost everything because we already know exactly how many houses we have. We know how many houses we're building permits. We know how many people are getting born. We know how many people are moving here, right? We know how many houses we have, how many we're gonna have, and we know how many houses we're gonna need. We know almost everything, right? We don't know exactly what's going to happen with interest rates, but they're probably going to go down. But the point is, we know almost everything that you need to know to make a forecast. So that's our forecast. So any questions on this? Any questions on this? Is this helpful for you guys? Yes. Yeah? Okay, you're welcome. So we're going to post this on our social media. You're welcome to download it. We update this every month. And as real estate investors, you definitely want to be a student of the market because the market is always changing and you want to understand where the market is. Like if you were here 5 years ago, we were telling you interest rates are 3%. This is not normal, folks. You shouldn't expect this to continue. You know, if you're investing in a deal, like a commercial deal at 3% interest rates, if it doesn't work at 7, I wouldn't invest in it, right? I just wouldn't invest in it, right? And that's what I was telling the syndicators, you know, 5 years ago, because it was risky, right? Now I would say is probably a pretty good bet to invest in some of those deals that were not a bet, you know, a few years ago. So we're going to talk about what to do in this market, but wait.